How you been?
Good, man.
You been good?
Yeah.
Business been good too?
Yeah.
Cool.
No complaints.
Yeah, man. Thanks for coming out.
Yeah.
You know,
Happy
like
to be here.
I've been getting hella folks calling me, messaging me on Facebook, Instagram, saying, "Chia, like I got a lot of money under the mattress and stuff. What do I do? Like all this, all that." So I figured, you know what? I can't be answering these questions legally, so I need a guy here to be able to answer all these questions. You know what I mean?
If they're not too hard of questions, I'll do my best to answer.
It's better you answer than me, though, for sure, right?
Fair enough.
So that's why I need you here, man.
I'm here. I got your back.
Appreciate it. So why don't you just kind of introduce yourself to all the folks that are watching, listening, who you are, how long you've been doing this, who you representing.
Yeah, totally. So my name's Nick Street. I've been in the mortgage business since the end of 2004. So that's a very long time. Nobody needs to do that math, please. But yeah, so I've held a lot of positions in the mortgage industry, mainly, you know, centered around production as a loan officer, which I'm still doing today.
Yeah.
I also am a branch manager, which gives me a little bit more flexibility in terms of communication with operations, but also pricing when needed to be. So right now I'm currently still with Mountain West Financial, been there a little bit over 6 years.
Yeah.
Direct lender, predominantly on the West Coast. And yeah, we're really purchase focused, mortgage originations, you know, specialize a lot in community-based programs, down payment assistance, first-time home buyer, you know, as well as move up, everything really in the purchase market that you can think of, we do.
Why do you think it's so important? Why would you even recommend like a first-time home buyer or even like a seasoned buyer, a buyer in general, to like get pre-approved first with a lender such as yourself before window shopping? Because I think a lot of individuals always assume buying a home is like buying a car.
Sure.
You go and test drive first, and then you do the application for the financing afterwards, right?
Right.
So why is it different from buying a car when it comes to buying a home?
Well, obviously, buying a home is probably the biggest purchase you're going to make in your life, if not one of, if you're buying multiple homes in your life. So that alone is a big difference, right? I mean, you're talking about a really, really massive debt and obligation. So you should really understand your finances, understand what your goals are in financing, so you're not rushing, right? It's a lot different than your analogy of buying a car where you can get out of there in an hour and drive off the lot. Well, with a home, you really wouldn't want to rush the process that way. So number one, I would say just make sure you have clear, precise goals going into financing. So, you know, that could be as simple as, hey, we really need to make sure that we keep our goal budget of a monthly payment under a certain amount. We need to make sure that we have a clear goal of not, you know, dipping into more than X amount in our savings.
Yeah.
So knowledge is power when it's anything. So home buying is no different. So really, if you have that knowledge up front, if you have a clear understanding, have a game plan, have a goal, it will really help you in that process. So you know better than me how difficult it is to sometimes find a home in our market today with really compressed inventory. So if you can alleviate all the homes that you don't want to buy and you shouldn't buy based on your finances, you can really kind of set yourself up with a better game plan for those that are in your budget, are in your price range, do fit your goals. You kind of give yourself a little bit more of an advantage when it comes to shopping.
That's true. Like there's so many times I work with, like, you know how whenever I meet a client for the first time, they don't know me that well. They don't trust me. I don't know them very well, but I'm trying to do the best I can to be able to draw them out, to open up to trusting me, right? And a lot of times they don't want to give me their pre-approval, or they're not pre-approved, and they know what to say so that I can show them the homes and all that. But I'll play along, submit the offer, and they shoot themselves in the foot.
Sure.
Because now the underwriting starts, they verify their assets, and they're not really qualified for that price point, and they get upset. Would you say that happens a lot with you, with some of the realtors that you partner with?
A little bit. I mean, it's commonplace. Again, I try to just take it a step back to making sure people are actually informed and educated and they have that knowledge, right? So
Right.
it doesn't really happen with me in terms of if that's somebody that I've gone through their finances or
Right.
set them up with. Typically, we're not having issues when it gets into underwriting because we've prepared for those
Right.
up front, right? And that's why, again, I think it's really important that you talk to the lender before you get
Right.
too deep into the process. Have I had situations? Absolutely, where maybe a realtor will call me and say, hey, they told me they were pre-approved. It went to this bank. It started. Now I'm a week into escrow.
Yeah.
Help me,
Yeah.
right? And that happens more than it probably should. But again, that's just the
That's
world
just
we live
human
in.
nature. Yeah, that's just
Yeah.
human nature, and I get it. So, what are some of the different type of programs out there for like buyers in general? Because I know that there's conventional,
Yep.
there's FHA, which a lot of first-time home buyers like to use because of the low credit score limits,
Absolutely.
and the down payment portion. So, can you share the difference between the two? Like even down payment assistance. Like, can you share the difference between all
Yeah,
that?
I mean that's a big answer to a short question. But yeah, so I mean it's good to identify both conventional financing and then government financing, right? So we know with government financing, the majority of that is going to consist of FHA, as you mentioned, but also VA,
Right.
which is available for veterans. Far and away, VA is going to be the best financing available for those who qualify, and that's a select few, right, that have earned that opportunity
Yeah.
from protecting us and serving in the military. If a buyer is VA eligible, they absolutely should take advantage of that, right? Why? Because those terms to the buyer are amazing,
Right.
as they should be,
Right.
right? We should want to help our
The
vets,
vets.
but it's 100% financing, so it does not require a down payment. The interest rates are very low, credit scores are very lenient, and there's no mortgage insurance. So even
Yeah.
at 100% financing, you get a low interest rate with no mortgage insurance.
Talk about mortgage insurance. Like,
Yeah.
what is mortgage insurance, and why do a person need to pay that?
So mortgage insurance is going to be required on any FHA loan. Okay, so the difference between maybe mortgage insurance on an FHA loan and a conventional loan, our conventional is going to be risk based. So conventional says, or conventional government insured entities create a system that says if there's enough risk, we want an outside company to insure it for us. So really, they want that if there's less than 20% equity in the home. So unless a buyer puts 20% down, they're going to require that third party to come in and insure the risk on that loan.
Yeah.
Right? Again, being risk-based, it's going to depend. Higher credit scores, higher amount down, they're going to have lower premiums or a lower monthly amount that you pay. FHA is different in the fact that, again, it's going to be mandatory and required at the same amount. So it's not risk-based pricing. They just have a flat amount that you pay on an FHA loan.
For the life of the loan.
For the life of the loan. Unless you put more than 10% down, then it will fall off after 11 years.
For FHA.
Correct.
But it has to be a starting point of the purchase loan to be 10% down or more.
Exactly. Yes.
So when does it fall out for FHA?
If you put less than 10% down, it's for the life of the loan.
But if you put more for FHA, when does it fall out?
It would fall off after 11 years with 10% or more down.
Good to know.
Yeah.
Good to know.
Conventional will allow you to apply to have that mortgage insurance removed after you hit that 20% equity threshold.
Right.
So you have a minimum time frame of 2 years. So after you've been in the loan for 2 years, you can apply, say, hey, I've been here 3 years, I put 10% down. I know that I've gotten on average about 4% appreciation year over year. You would then contact your mortgage servicer, let them know that you want to apply now to have your mortgage insurance premium removed. And it happens all the time. Every lender and every servicer will have a process that you'll go through to do that.
Got it. So let's talk about down payment assistance. There's also like CalHFA for FHA and conventional, right? So why would somebody want to use down payment assistance over like FHA or conventional?
Well, a lot of times it's as simple as their resources are limited. right? So again, we know that with FHA financing, the buyer has to bring in a minimum of 3.5% of the purchase price. And we know that with conventional, if they're a first-time home buyer, they have to bring in a minimum of 3%. What a program like CalHFA or GSFA or a number of different down payment assistance programs out there will do is they'll supplement some additional funds and let a buyer use those funds to meet those minimum down payment requirements. So a misconception is that somehow that program allows you to do 100%. That's not the case. It's still a regular FHA loan with 3.5% down, or a conventional loan. You're using another entity to obtain the funds to make that minimum down
and that
payment.
funds could cover a majority of the down payment?
Correct.
Or is it just a percentage of that down payment?
Typically, it's always going to be based upon covering the full amount of the down. So there isn't a minimum down that a buyer has to bring in on top of that. Where it will sometimes get tough is going to be your closing costs.
Okay.
So your closing costs on those programs are typically going to be higher than they are on a normal loan. A lot of them do allow for additional liens or even other programs that can be stacked on top of the down payment assistance that can help supplement for closing costs also.
Okay.
But having a buyer come in with little to zero money is difficult, right? So a lot of times you're maybe having to go to a seller and say, hey, we're going to need some additional seller
some credits
to help.
So what are all these advertisements I see on social media saying you only need $3,000 and you're qualified?
Sure.
Does
Those programs exist. So yeah, I mean, you shouldn't think that that's fake news, right? There are programs out there that do allow that. It's for a unique individual.
For sure. So everybody's situation is different.
Absolutely.
Because I guess so many people are calling me, right? They see that and they send me a screenshot saying, is this a scam? It's like, It's not a scam, but it's not based off of everybody's scenario.
You would have to fit within that window of opportunity.
Right. You got to be within that criteria or qualifications, right?
Of course.
Yes. And down payment assistance, is there an income restriction?
There are. Now, depending on the county that you're buying in, they're typically higher than you think. So more people will qualify for down payment assistance than maybe they think that they do. So I'll give you an example.
Yeah.
CalHFA, for instance, has, what would you guess the income limit is for CalHFA?
Individual, maybe 35 grand a year.
So it's $165,000.
A person?
That's per household.
Oh, okay. So it doesn't matter how many people live as long as it doesn't go over that.
Correct.
Holy smokes, they increase it a lot.
More than you think.
Yeah.
Right? So again, the buyers should always be aware of what opportunities are available to them.
Right.
Now, does that mean because they make under that, they absolutely should use a CalHFA program? Absolutely not, right? They should know what opportunities are out there and discuss it with a lender that's qualified to give that information.
Right, because down payment assistance, interest rates are normally higher, right?
They are, yeah. So you have to understand, right? There's an inherited increase in risk.
From the banks.
From the banks, right? If a buyer's literally not coming in with any money.
Yeah. That's a high risk.
That's a higher risk.
So then they get their money back by increasing the interest rates.
You got it. Yeah.
Got it.
And typically we would look at it and say, hey, instead of maybe bringing that money in, you're financing a little bit more of that down payment, right? By paying a higher rate of interest.
Some individuals that go with FHA or conventional, they prefer a higher interest rate so that they can receive more credit back. Can you talk more about that?
Yeah, so I think you're talking about like on a traditional FHA or conventional loan. There's a way that you can do a lender credit. I think that's where you're going. So a lender credit will allow a buyer to get credit from the bank to offset some additional costs or closing costs, right? So essentially, you'd have to look at that from a lender's perspective. Why would they give money up front? Because they know they're going to make more over time.
Interest rates.
Right? So if they have a higher rate of interest that a buyer's paying on, they're going to collect more interest over time to recoup that extra money that the bank may be putting up for closing costs. Right?
So then it all boils down to how much the borrower's monthly budget range is in. If it falls within that monthly budget range, then you guys could normally mess around with the interest rates to see what's going to benefit them.
There's not a one-size-fits-all loan. right? So yeah, so everybody's situation is going to vary. So some people have the opposite. They have a very distinct budget where they have to get it down to a certain amount. So they're doing, instead of taking lender credit, they're wanting to buy down their interest rate, right? So there's a flip side to that, which is they can pay more in upfront costs for a lower amount of interest, which is, again, the flip side to the lender's perspective, which is, hey, if we're going to give you a lower rate of interest over time, we're just going to charge you a little bit more upfront to do
for the fees.
Yep.
So when borrowers compare rates, right? Because a lot of people that I talk to, they would just go to their initial bank that they're banking with, whether it's a big corporate entity like Bank of America, Wells Fargo, or Chase. They normally like to go there first and not shop around independent brokers or like even a company like Mountain West. Why is that?
Probably comfort for the borrower. They probably feel that they have a comfortable situation with that person. So, years upon years ago in the credit crash, the perception was that either independent mortgage bankers or independent mortgage brokers were somehow a cause of that. Now, a lot of time has passed where I think that that feeling has changed a lot, but I think it's still in a buyer's, their psyche is, hey, if I already know this place already knows me, I already know them, I feel comfortable going in here. Now, again, there's nothing wrong with that, and I'm sure, for the right person, a depository banking institution will give them a great loan. However, a depository banking institution is going to be a little bit more limited in the available programs that they offer.
How so?
That box of loans that they have or the guidelines that they adhere to are typically a lot stricter. They usually won't have access to a lot of the down payment assistance programs, be it especially on more of a localized level. Because again, you got to think a bigger bank is making decisions at a higher level. They're making decisions from more of a corporate aspect. Whereas an independent mortgage banker, for instance, right, all we do is loans, so we don't have
specialized.
We really don't have other factors at play that are going to cause us to maybe shrink or mitigate risk on a mortgage side. That being said, there's a lot less red tape. So if we want to initiate a localized program or we want to do things a little bit differently or unique for one person, we can really do that because we have that nimbleness or that flexibility to be able to offer something like that.
I see. Let's go back to down payment assistance. I heard that they're going to be going away with that program eventually. How do you feel about that?
Like they're not sure where you heard that, but I don't think that that's the case. I think that the agencies that are offering down payment assistance now are strong, and things have been going great for them. Right, default rates have been extremely low. So I think all of these programs are pretty flush with money right now to a point where I don't think that there should be any trepidation from a buyer standpoint that down payment assistance is going away per se. I think that we really do have, an issue, especially in California, with affordable housing. So we really have to stimulate as many new buyers into the market as we can. So there's always going to be some form of assistance for buyers when it comes to down payment.
Yeah, so talking about low income, there's SHRA. Are you familiar with that?
I am.
And can you share a little bit about that? Because you guys do loans for SHRA as well. You guys are one of the preferred lenders.
We are, yeah. List. So SHRA is unique in its own right. So what SHRA does, and I think what you're asking is like their tract of homes that they own and they build and then they sell, right?
Right.
So the hard part there is that one, they have some pretty tighter income restrictions for those homes. But what a lot of buyers don't understand is they'll have maximum appreciation levels for those homes as well. Meaning, so if you buy that home today for $250,000, you can't sell it in 2 years for whatever you want to or whatever the market appreciation has.
Right.
They'll cap the amount of appreciation that you can sell a home for, right?
Why do they do that? Is it
to keep homes affordable? So they're not trying to make profit, right? So buyers just need to understand that it's not the traditional route of
Buying a
I buy a
home.
home for this, and now
I
that's
flip
going to
it down
be
the
my
line.
best investment towards my future, right? This is to still allow that homeowner to maybe achieve that reality of home ownership that they maybe wouldn't have the opportunity to
Right.
in a normalized or centralized market, with outside of a program like that.
Right.
Typically within that, you're going to have, so say you have a resale and you're the seller, but your maximum that you can sell the house for is $250,000. Guess what? You're going to get 25 offers all at that maximum amount.
Yeah.
Because those homes are still in high demand.
Yeah.
Right.
Right.
So as long as that buyer has gone through that that process of making sure that they're approved with an SHRA lender, they can certainly make an offer on that home. But that seller is going to have a multitude of offers, all very, very equal, right? Or essentially all equal.
Yeah.
So again, it's a tough market for a buyer to concentrate on wanting to buy those homes.
To build wealth.
Well, or just get an offer accepted if it's that really, really competitive type of a situation, right? So, again, not that I would say don't pursue that, but make sure you have your options open and don't narrow it down to that.
And with SHRA, like, you can't really pick and choose what area you really want for sale because they might not have inventory in that area.
Yep.
Right? So I've seen that a lot. Okay. So what about a borrower that has cash? Like
cash is king, right?
Yeah, cash is king. They hear that all around, and now they're speaking to the lender, and the lender's like, you got to source that cash.
For sure.
Share a little bit about what sourcing is, why it's important, and if a person does have a bunch of cash laying around under the mattress, can they even use it to buy a home?
Absolutely. So I'll tell you from a lender's guideline perspective how cash is viewed, right? So any assets or any funds that are used for a home purchase have to be sourced and seasoned. So what sourcing means is you have to know the source of where it came from. Cash, you really can't tell what that source is, right? Sure. And I know there's a lot of people that, for whatever reason, have a mentality that they don't like to keep their money in the bank. And they cash their check every Friday and they keep the money at home. However, right, from a lot of different reasons, government regulations being one of them, there's just no way to know if that money that was legitimately sourced by a buyer and hid under a mattress has ever been commingled with maybe some illegitimate money, right? Maybe money earned that taxes weren't paid on or earned from an illegal enterprise. Again, no judgment passed, just how a lender would perceive cash. So the main ways that as a lender we would say, here's how you would alleviate that concern from a lender. Number one is if money is deposited for more than 60 days, a lender won't go back any farther than that. Okay? So know that. Again, it's essentially 60 days it's 30 days on some loan programs, but no more than 60.
What if they want to buy a home now? They don't want to wait 60 days. So 60 days they get kicked out.
So again, you can't use your cash. So that's probably first and foremost. There's no way to say, I have this amount here's my money, I'm using this for your down payment. Typically, what we'll do in those situations is they'll find a family member that may have
a donor
source of money, and they can get a gift. They can get a gift fund, a gift amount from that donor. Now, the gift is just that, it's a gift, right? There's no promise to repay.
Right, it's not a loan.
It's not a loan. It is a gift. Now, family can work out family type of arrangements all the time. By no means does the lender going to investigate anything like that after. But say you got a gift from your family, you may give them a gift at another time, right? That would help them. So so typically, yes, in an area of cash, you either set up a game plan so that buyer knows, okay, I'm going to deposit my cash and then I'm going to wait a certain amount of time
Mm-hmm.
so that I'm ready, or you're investigating which family member may be willing to assist them with a gift.
Got it. The person that's providing the gift now, the family member or friend, are their funds going to be sourced? Or yeah, at that point to
So
where
there's a
verified.
little bit of a gray area there. We're not going to underwrite or audit a potential donor because they're not applying for a loan.
Mm.
But they have to show an ability at time of gift to gift. So say that denomination is $10,000. They had zero. They made a deposit of $10,000. Now they're giving a gift of $10,000. Some questions are going to be asked.
Got it.
Right? Again, they're not trying to underwrite or audit or make life difficult for that donor. The fact that they're going to gift a family member money is great. They should be praised, not chastised. But again, it has to make sense.
For sure.
And an underwriter's still going to do their due diligence and kind of.
Is this all across all platforms, like conventional and FHA and VA?
Yeah, I mean, everything in that realm is pretty common sense, right? So yes, in terms of cash, it's going to be that's going to be the same across all loan programs and loan guidelines, and same with gifts.
Got it. So even if a person does have cash, don't think that you can't buy a home now. Just try to talk to family members that do have the funds ready.
You should talk to a lender who can help you come up with a workable solution.
Great.
Yeah, I mean, the right lender will be able to set you up with a game plan.
That's great. You're in management for Mountain West.
Mm-hmm.
Would you consider yourself a broker? Like, what's the difference between you being a broker, a regular loan officer, a lender? What is that, direct lending?
So we're a direct lender. So really the definition of a direct lender is that they lend directly to agency guidelines. Agency being Fannie Mae, Freddie Mac, HUD, who does FHA. So the main difference between maybe a direct lender and a broker is that the direct lender is going direct to the source. So typically they're having a little bit, not to put down a broker, but you're going to usually get a little bit better communication. Your timelines can usually be a little tighter. There's more control over that aspect of the loan, of all aspects of the loan, I should say. A mortgage broker, right? They're going to have to go to a lender, and then a lender. Correct. So a lender like Mountain West or many other lenders out there, a broker would then go to a lender. So there's, obviously an extra step and an extra layer. Depending on how that lender puts forth their process, there just may be some limitations on what that loan officer or what that broker can do, meaning who they can talk to, how quick they can move things around, etc. So, again, the person who's got perfect credit, putting a large amount down, they're probably going to get a loan anywhere, right? So should they be fearful of using a broker or a lender or a bank or anyone else? No, they probably should be open to using whoever they feel they're most comfortable with, right? But the flip side to that is if they have a home that they want to target that we know is going to be really, really sought after, and they're going to have to make an aggressive offer with aggressive timelines, things like that. Typically, a direct lender is going to give you the best opportunity because they're going to be able to close the fastest, right? They're going to be able to do enough on the front end up front so that when that loan gets into escrow, things can move very, very fast.
I know, man. I think the fastest I've closed with Danny is 11 days.
So 10 days is the law. So as long as, and we've done many in 10 days.
That's crazy, insane. That's like cash.
It is.
It's like cash purchasing.
It is. And so that's what we want buyers to know, right? If they do enough up front with the lender, they can really make an aggressive offer that may set themselves apart
from the competition.
The multiple offers that are out there.
I know. I always recommend buyers to speak to their lenders ahead of time, especially in the competitive market, right? Because some lenders, like what you said, might have another layer of communication to where it may take them longer to be able to close the loan. So then now you don't even know if you're going to be able to perform, but this other offer comes in and it's the same offer as yours, but they could close sooner and then they get the house.
Right. You have to think about a seller, right?
Yeah, exactly.
They want their money faster. They want that security.
That peace of mind, that assurance.
Absolutely.
So how long have you been in lending now, Nick?
16 years. Yeah.
That's a long time.
Yeah. Yeah. I could drive.
If somebody wanted to approach that line of work, how would they go about it?
I would say they need to identify what it is that they want to do, right? And understand why they want to get into that line of work. Don't get into mortgage lending because you really want to make money, because it's hard, especially when you first start. You should want to get into mortgage lending because it's interesting. You like working with people. You like helping people. You like numbers, right? You're kind of interested in problem solving, because that's a lot of what we do every day. What they should do is there's a licensing aspect that would need to happen, but
you got to get your real estate license too, right?
No, actually, you just have to you can, but depending on which side of the business you want to work on, to work for a bank or a direct lender, you just have to have your NMLS mortgage license. There's a background process that you need to go through, and then a state and federal test that you would need to pass, as well as some pre-licensing coursework that you have to take class up front. My best advice would be find somebody who you identify with, and maybe try to get them to mentor you or give you some information about it, right? I talk to people all the time. Not that I try to talk them out of it, but I'm just really honest in what their expectations should be getting in, right? That initial phase of entering in the business is going to be a lot of work and a long grind without too many wins, right?
Of course.
So you better be prepared.
Because you're in business.
You better be prepared to keep putting in the work, even though you're not seeing instant results, right? Now, that may be different for some people. Some people may hit the ground running and come out of the gate fast. By all means, those people exist. But prepare yourself. Have a cushion for finances, right? That you're not depending on closing 3 loans your first month or your family won't eat, right? Don't recommend that, right? Allow yourself, right, to really learn the business, become educated, set the right foundation, partner with the right people, take time to do all those things, and make sure that you're not rushing into any aspects of it.
You work majority with realtors,
correct,
right? Or when you're starting out in this field, like, do you? Because for me, I'm a realtor, so then I park my license under a broker for the first 2 years, to be able to sell real estate, and because of that, my team, they provide leads sometimes so that I could start my business strong, start having people to call, see if they want to buy a home, like sales, right?
Absolutely.
Is it similar to that aspect for a new person coming in?
There's a lot of different plans, and ways that you can create a path for success in mortgage lending, right? Somebody that wants to do it based solely on their own relationships and what they bring in the door is obviously going to get paid a greater amount than somebody who's relying on their company to facilitate leads and opportunities for them. So I think any lender that's set up the right way is going to have both avenues, or even an avenue that can be mirrored on both sides. So like for us, you can come in and have opportunities to create your own relationships, but also call on leads, things like that.
Are you planning on expanding your team? Because I know that you have Danny under you right now, Jessica.
So we have a few different lenders on our team. We're always open to the right people. I would say, are our plans to expand at a great amount? No, we just like to really expand based upon opportunity and based upon what we feel is the right fit. So we're definitely not out there aggressively recruiting
Okay.
or actively looking. But when the right people come across that we feel are a great fit, then we would love to accommodate them.
Yeah, and the reason I'm asking is because you're getting ready for a new building, a new
Yeah.
office.
Yes.
And how long has that been going on now?
So the project started December 2017. We're now in 2020. So we're targeting an opening of May 2020 is when we think we'll be in the building. So we've learned a lot about building codes, city politics, but we're definitely excited about the new home, about the space, about the opportunity,
Yeah.
about what it's going to allow for us to collaborate with our partners and some of the shared spaces that will be in the building.
How big is it?
It's about 3,000 square feet. So it's not huge by any means, but it's centralized within the city. So for me, it was a big deal to not only have this building, but also reinvest and revitalize, the city of Sacramento, which is my hometown, which I have a lot of pride in. So redeveloping an old, dilapidated, rundown building, making it fresh, making it new,
come alive,
making it pretty, in an area of town that I'm really familiar with, that I have a lot of history and roots in, was really important to me. And so that was like more of a side aspect, reinvesting what's given me a lot, right? The city has always taken care of me and given back to me. So this opportunity allows me to reinvest in the city, but also have a really, really cool place that people will recognize, people will know that it's us. Maybe it will mean some additional opportunities that other lenders will want, to join us. But that's definitely more of a side aspect, not a goal going into it.
Throughout your 16 years of doing this now, how many families would you say you have served in Sacramento?
Wow, that's a good question. Tens of thousands. So,
because you guys do refis too, of course.
Yeah, the refinance market is busy anytime there's a rate downturn, which we have seen, and interest rates are aggressively low right now. So yes, I mean, by all means, if there's people that need to discuss their refinance, they should be talking to their lender right now. But yeah, no, I mean, we've taken great pride in the amount of families that we've helped, in just kind of developing that system of, I'm not just here to help you with your mortgage, but I'm here to help you plan your finances for the rest of your life. So
that's good.
Many clients call me for topics unrelated to even their mortgage, just to get my opinion. And I really tried to develop those relationships with clients so that they feel comfortable in doing that. And just letting them know that we are here, we are available, we do value, those opportunities as well.
Are you guys, so because you're in Sacramento here, if let's say a client wants to use you because they like you, but they don't live here, how far can you guys service?
So we're licensed in the state of California, all the way up and down. We're also licensed in the state of Washington. And we have licenses predominantly on the West Coast. Individually, I'm just in California and Washington, but if there's somebody in another state that wants a good referral to another branch of Mountain West, or another loan officer that I'm familiar with, that I know, that I trust, I'd be happy to give it.
Got it. So you can go anywhere in California then?
Absolutely, yeah. And we do it quite a bit. So there's a lot of times where we may start with a client here that's buying a second home, maybe retiring to Southern California, or there's a family member that they have. So we'll get a lot of referrals for out of the area. And in our geographic area isn't, just Sacramento. We'll do a lot in Yolo County, Placer County, El Dorado County. Even in the Central Valley, we do quite a bit. Stanislaus, San Joaquin, Amador County. So, again, it's wherever that client is looking to buy. Sometimes, the city center is pricing them out.
Right.
So
they go to the outskirts.
Correct.
Must be nice, man. I wish I could help a client buy a home in like Southern California and
You
not fly.
can.
Yeah, but I gotta fly out there.
You have to do the work.
You can just be at the comfort of your home and just helping them with the loan.
Yeah.
Okay, that's cool. So, like, what are some of the other things that you would probably like to share with all the viewers
About myself?
about yourself, about anything regarding the mortgage? Any tips at all?
Yeah, no, I mean, again, my biggest tip for a home buyer that's starting out is just focus on what your plan is, right? Focus on what your goal is. Is your goal to buy a home for what reason, right? Is
Invest
it to,
or live?
Exactly. Is it to improve the quality of life for your family? Is it to start with an investment, right? So, and then share that with your lender. So,
Yeah.
hey, my goal is I'm going to be here for 2 years, and then I'm going to want to upgrade, right? I'm going to want to get a bigger place. Hey, my goal is to get in this area because they have the best schools for my family. And then we figure out how much it costs to be in that, and then start to put a plan together for you. So, unlike any other major decision that you make in life, make sure that you're prepared for it, right? Rushing into it after you've seen the home and you want to do it, can we accommodate that? Absolutely, right? But is that my best advice? No, of course not. I would say again, make sure that you have goals in mind of exactly what it is that you want to do. About us, we're more than anything happy to help you meet those, right? So we don't view your situation as another unit or another loan. We'll really cater it to you as an individual. When we say how many loans have we closed, it's how many families have we helped.
Yeah.
So we're not monetizing it in any other way than did we meet and did we surpass the goals that you set out, right? That's what's most important, and that's what allows our clients to refer us more clients and to become clients for life, which is ultimately what our goal is in any interaction, in any relationship. So again, that's really what we set out to do. We're members of the community. We're active in the community. We talk all the time about what I do outside of work, which is, be really active and give back, and use sports and
you coach your kids, yeah.
Coach my kids basketball, coach my kids baseball. We're active in soccer. We're active at school. Wherever we can help. I said, and I don't even mean it in a cheesy way. The community is what made me, right? I would be nowhere without the community support, be it realtors, be it escrow officers, builders, all of the different people that support me and allow me the platform to help people that I want to reinvest back into my community, right? So from donating our time, donating our money, wherever we can help, we're more than happy to do so.
That's great. You just remind me of something I wanted to ask from some of the viewers that's been calling me. What would you consider a good credit score starting off for a first-time home buyer? Like what would be considered a qualifying credit score and a good credit score?
So most of the down payment assistance programs now have a bare minimum entry level of 640. Cal HFA has actually moved even higher. So they're at 660 now for FHA and 680 for conventional. Just because you're at a lower score now doesn't mean that you're stuck. What you should do is work with your lender to help you figure out a plan to improve your credit.
Right.
Now, if your credit's bad because you've chosen to not pay a lot of your debt for a long period of time, it's going to take you a little bit longer, right?
Yeah.
That's a little harder to recover from. Some of it is you just have your debt allocated in the wrong positions, right? So maybe you need to move some debt around, right? Maybe you're heavy in installment and limited in revolving, or vice versa. So it's important.
What is the difference between the two?
Yeah, so an installment debt is a student loan, an auto loan, a personal loan.
Something that has a deadline, basically.
It has an amortized repayment schedule. So this is for 30 months, I pay this amount. And at the end of that 30 months, that is debt. That is done, right? That installment has reached its expiration. A revolving debt means that amount is going to depend upon how much you take and how much you pay down.
Credit cards.
And then there's still available credit to get it, like a credit card or an equity line. right? So typically, if you can, on your revolving debt, you want to stay, if possible, under 30% of the limit. Meaning if you have a $10,000 credit card, you don't want that balance to exceed $3,000, right? Obviously, if you can pay them all the way off, that's great. You're going to minimize the amount of compounding interest that you pay. But for purpose of helping yourself, start to work towards inching those down, right? And the right lender can kind of help you put forth a plan for that. There may be some areas where it makes more sense to keep a higher balance, right? You're at a 0% APR. By no means do you want to be in a hurry to pay that down versus one that's at 23%, right? So again, discussing that, creating that plan, all of that's going to help you. Just like in anything else, each credit score is going to depend upon what your goals are and what your plans are. If they're to use down payment assistance, if they're to get the lowest possible interest rate out there, all those credit score models are going to change. So credit is sometimes can be very subjective. You may think you have good credit, but you might not. Or you may not think you have good credit and you do.
You do.
So again, you just kind of have to get started. I would say, using the resources that are out there like Credit Karma or Mint or things like that can be okay, but you shouldn't think because your Credit Karma score says that you're one thing, that means you're eligible to buy.
Right.
It's great for monitoring. It's great for gathering information. But you shouldn't be making financial decisions based upon the information that you get there. Because those are not credit scores.
And they also don't provide you with all the credit bureaus. They only give you 2, I think, right? TransUnion, Equifax.
Typically 1 or 2, but again, they're not actually lending you money, so they're not actually getting a score from a credit bureau. They're credit monitoring sites, which are there to kind of give you a range or a guess based upon the information that they have, which is quite frankly limited.
For an investor, right? Going back to what you were saying earlier about what your goals are as a borrower or buyer.
Yep.
If it was an investor, right? Let's say he already owns a home, but he wants to rent it out to buy an upgraded home for him and his family. How would they go about that? What would be some of the scenarios for that?
So one is they would have to have enough down payment, right, to make another purchase and have the resources to do that. They can do that with as little as 5% down. So it's not like they need to have a huge amount of savings. And in fact, I've seen many individuals, young, old, in between, establish a great portfolio of real estate, buying, living there for a few years, renting it out, buying, living there for a few years, renting it out. I mean, I've been doing it 16 years, so I've had quite a few people go through a process. Right?
And why do people do that?
Well, we know that acquiring real estate as an asset is extremely valuable, right? For a number of reasons. 1, taxes, right? 2, equity appreciation. I mean, real estate's undefeated, right? Even when it fell, it came back.
Right.
So it's important to know what your goals are. If your goal is to buy and hold, then that's different than I want to buy and sell, right? Because different properties may come into play in that situation. I think you should look at real estate from an investment standpoint if you're actually going to live there as a long-term play, not a short-term.
Yeah, because when you're buying as a primary, right, to live there, down payment obligation is lower compared to an investment.
Correct.
Right? Can you talk about that?
Yeah. So in investment, and I'm assuming we're going to talk just single-family home for now.
Single-family, yes.
So a buyer buying as a primary residence, owning another home, wanting to buy another primary, like I said, they can buy with as little as 5% down. An investment purchase of a single-family home would have a minimum of 15% down. So it's 3 times the amount.
Yeah.
15 is still going to be more of a bare entry position, so your loan terms are going to be worse. Typically, we'd recommend at least 20. If they can get to 25, is more appealing. And again, it's based upon risk.
Right.
So the investment purchase carries a lot more risk for a lender than a primary residence. Why? Well, if, say, something happened financially with you and you came into a hardship, for you to stop paying on that property that someone else lives in wouldn't be as tough as for you to say, I'm going to stop paying the home that I live in, uproot my family, and go somewhere else, right? So that's really what it comes down to. If you had a financial hardship at place, you're not that emotionally tied to an investment property.
If an individual had a rental and they want to buy a second property, but then they want to leverage off the primary guidelines, which is a lower down payment because they're going to be living there, and they want to be able to utilize their first home as a rental, can they utilize that rent income to qualify to buy the second home?
Absolutely. So
100% of that?
No. So they can't use it as income per se, but what they can use it as is as an offset to their current mortgage payment.
On the second home?
On the primary home.
Oh, on the primary, okay.
So and I should take that back, on the house that they're leaving. So we would call it departing rental income. What they can do is they can use 75% of market rent to offset whatever their current mortgage payment is on that home, right? So that kind of alleviates the need to qualify from a debt to income perspective with both mortgage payments. Now, if you have a history of renting out any property, they're going to use the income that you have reported on your taxes to help kind of qualify based upon that. So we'll get that question quite a bit, which is, oh, well, I've rented it under market, for the last few years, but now the rent's higher. Can that help? And unfortunately, the answer is no. Because they're going to go by what you have reported in rental income.
What can they do in that position to change it to market value? How long would it need for them to be able to source that rental income to be able to...
So typically in that situation, they're going to have to show either the improvement that was made or the difference, right, that was done to get there. So I'll give you an example. Like in certain cases, you would have, hey, we reported way less income because the house was vacant because we were making massive construction renovations. Okay, as long as you can prove that, right, then you have a renter in there now, they would use what the current market rent is. Something like that. Something would have to have been at play, not I wanted to give a friend a good deal. Typically, you're going to be stuck until the next tax return when you report the accurate amount of rent.
Got it. Okay. Do you have any rental incomes yourself?
I do. Yeah, I have a few rental properties. Yeah.
Okay. All right, man. Well, I guess we could just close it up, man. If anybody want to reach out to you, like, how would they go about that?
Yeah, so you can reach me. I'm at localsaclender.com. That's where you'll find my website. You can cruise around there, learn a little bit about me, see testimonials from other clients. You can apply online if that's your preference. You can. My contact information will be there as well. Just call my cell, text me. I'm not that difficult to reach, and always
sometimes
always try to be available. If I'm not available immediately, I'll try to give you an alternative avenue or window of opportunity to talk. I also am lucky enough to have a really good supporting team with me. So again, if for whatever reason individually I'm tied for some particular reason, a team member of mine will absolutely be in touch.
For sure. And I'll put your contact in the description so that way it's easy for people to get that info.
Great. Yeah. Again, the right lender will make all the difference. So if not me,
talk
somebody who you're very comfortable with.
Cool. All right, man. Thanks, bro.
Yeah. Thanks for having me.
Yeah, man.
All right. We did it.
We did it.